Hey everyone, welcome. It is Sunday, April 7th. Looks like at about 3:15 p.m. on Pacific time. I am traveling and a little bit unexpectedly, a little last minute. So I apologize for any wind or background noise that you might be hearing. I'm just not in my normal recording environment. So we had quite a eventful week last week where we saw this huge downward day happen on Thursday. And on Friday, we had a little bit of recovery. So it was great news on Friday that we were able to move upwards, but we need to see if Friday was enough to give us confidence that this upward trend is going to continue. And if it's not enough, then what are we going to look for in order to get that confidence? That way we know whether we can start to get more comfortable with the continued uptrend, or we still have to be wary if we need to re-examine our hedges, put on new hedges, make decisions like those. So let's take a careful look at what's happening in the S&P 500. So first thing that I'm going to note is that we came up here, we made an all-time high right around here, and let's see if there was this one was at 524.11, this one's at 524.61, and this one's at 524.38. So it was this day right here, Thursday the 28th, where we hit that all-time high, and since then we've dropped. And if I just look purely from that perspective, the next day we came down, the next day we gapped down all the way to the EMA 20, then we went tiny bit up, mostly sideways, and then we tried to recover and we ended up way down and we broke the EMA 20. That was the first time we've broken the EMA 20 this entire uptrend since October of last year, at least in the S&P 500. There's been times where we've broken it in the QQQ and in the Dow Jones, but in terms of the S&P 500, this is the first time where we broke that EMA 20 significantly and closed significantly below that EMA 20. So here we made a dipped intraday, touched it, maybe barely went through it and came back up. Same with this, barely touched it. Here we traded through it, but recovered same day. Here we ended just a tiny bit under the EMA 20. This is the first time we had a huge bar with conviction downwards below the EMA 20, and that was the largest bar we've seen in this entire uptrend, although not the largest bar in terms of volume. So this was a very, very, very significant event and very significant day. What I see here is since that all-time high, we were still low. And it is great on Friday that we were able to get above that EMA 20. It looks like, though, we might still be below that EMA 8. So we closed at 518.43. The EMA 8 is at 518.47. So we're still just a hair below the EMA 8. We did trade above it, but we traded right back down below it, and we closed below that EMA 8. That part is not great news. It would be a lot more comfortable if we traded above that EMA 8 and stayed there on Friday, but we didn't. And what you've seen me do in the past times when we've pulled back is we've adjusted this line a tiny bit. We've made micro adjustments up and down, but I am not going to adjust this down to here like this time. Number one, because that's too much of a movement. That's too far below. That's too much of an adjustment. I can move it up and down a tiny bit, but not this much. That's too much. Number two, we always adjusted it to roughly the EMA 20. So even if I was going to adjust it, we would adjust it kind of like this. We wouldn't adjust it all the way down, and in which case it still looks kind of like we're in trouble right here if we do this. We might just be barely above that trend line if we did this, but we're not going to do that. We're going to leave it the way it was, which was like this. And what we see then is that it came down and it tried to recover and it touched the EMA 8, it touched this previous uptrend line, and it got stuck there, which means it could bounce off and come right back down. What we would want to see is a conviction move upwards above this trend line, above that EMA 8, and it's staying there. So we're still in danger zone. We're still not comfortable. Yes, it's great that Friday we recovered some, but this is still the danger zone, which means I still want hedges. I still want paired positions. So until this gets above that EMA 8 and comfortably comes back and touches these all-time highs, we're going to be in this kind of tenuous, uncomfortable position. And even if we match the all-time highs, this upward slope or this upward line is getting really close. We wouldn't be comfortably above this uptrend line anymore. So we really need to make new all-time highs in order for us to continue to believe in this uptrend. For now, it's looking like we're at a decision point. Either it's going to bounce back down or it's going to continue its movement upwards. And so since we're not that confident, we need to have our hedges. This is a more dangerous point than we've seen in this entire uptrend since this past October, and we need to be even more careful than we have been in the past. So we're definitely going to keep our hedges in place, or we're going to keep our portfolio hedged, and we need to examine whether or not we need to refresh the hedges that we already have in place. To support this, we have our EMA 20 has now flattened, is no longer upward sloping, and our EMA 8 is actually looking like it's starting to curve downwards. So that's not giving us a lot of confidence in terms of this uptrend surviving as well. In the past, we have seen this EMA 8 curve down or flatten, but the EMA 20 has always been moving upwards at the same time. This time is different. The EMA 20 is flattened. On a longer term basis, we can see that we've dipped below the 1 month line right here on the monthly chart, and we're below the 10-month moving average on that monthly chart. We came back, bounced back up to touch it. So once again, we are in this deciding point to see if we are going to bounce down off of a resistance or if we're going to be able to break through it. So again, we are at this deciding point that is a little bit uncomfortable. If I start to look at it from this perspective, I showed you maybe 1 to 2 weeks ago, we have these trend lines, we're not adjusting them. The Dow Jones Industrial broke through its upward trend line and chopped sideways. The QQQ broke through its trend line and started to chop sideways or move a little bit downwards. And now the QQQ finally has joined the pack and has broken through its trend line and started to chop sideways. So we can either move in this sideways chopping region or potentially come down. The lower probability event now is the continued movement upwards. But for now, since there is still a large amount of uncertainty and we don't have a high conviction in a directional movement, then we're just going to balance out our portfolio. We want to shift to a more neutral stance. So that's what all of this is telling us. Until we get proven that the uptrend is going to continue, or we get proven that there is a downtrend in place, then we want to stay neutral. So when we get those signs, we will readjust the portfolio. But for now, we want to start to get neutral. So that means for every long, we want to have a short, or we want to have on our entire portfolio basis, we want to be hedged. But even if I have an upward pointing portfolio that is hedged, that's still not quite appropriate for this current environment, because really we're seeing a sideways chop with the potential of moving downwards, or a higher potential of moving downwards than the potential of moving upwards. So we really do want to flatten that portfolio and not just simply hedge a upward pointing portfolio, a bullish pointing portfolio. So let's take a look at let's just reconfirm on a larger picture. The S&P 500, if I look from this perspective, it does still look like it might be in that uptrend, but if I look right here, in this region, we are really starting to get sideways. And we had another sideways region right here. We just did it at a slightly higher level right here. So we're seeing the sideways movement. We're starting to see the flattening out of the number of stocks above their MA50 and the number of stocks above their MA200. You see that we're not trending upwards anymore, and we're stuck here at about 70-ish% and 75%, and we've been like that for a little bit of while. So In terms of momentum, we have been stagnating. We have been going sideways for quite a bit. It's just that we had a whole bunch of sector rotation during this period, which allowed the S&P 500 to continue to move upwards instead of stagnating and going sideways like the momentum has. But that can't go on forever. If we don't have upward momentum, there's only so long these prices can continue to move upwards. Right now, we're at a CPC of 1.11, which is a slight extreme, and this is normally a point where we expect it to pull back down. If it pulls back down, that means a downward pressure inside the S&P 500. We also see volatility has risen. Right now, we're sitting at about 16, so it's slightly elevated. Remember, we get into 17, 18, 19, 20, then we're going to start seeing this market move downward a lot more rapidly, but 16 is on the high end of normal right now. So if we don't come back down quickly, then that gives us a lot of potential for this market to start pointing downwards. So we're having a shift in perspective, a shift in what's happening inside the markets, and we need to prepare by shifting our portfolio into a more neutral position. And then when it's appropriate, if the market gives us the signal, then we shift back up into a bullish pointing portfolio, or we'll shift down into a bearish pointing portfolio. That's basically all we want to look for inside the markets. We just want to take a look at our hedges and make sure that they are appropriate for our portfolio and start to maybe take some profits on some long positions, start to consider some short positions in order to get our portfolio into that more neutral state. So next week is going to be fairly important in terms of economic news. I can't get it on Econo Day, so I'm going to use this trading economics site. We've got Monday, maybe not anything. Consumer inflation expectations, maybe a little bit. That's not going to be super eventful, but that is going to be something that people are going to pay attention to. And it looks like over here, core inflation rate, CPI. I don't know why that's not highlighted by these guys, but CPI is going to be extremely important. Inflation is going to be extremely important. We've got the FOMC minutes coming out on Wednesday, so that's going to be very important. PPI coming out on Thursday. Jobless claims will be paid attention to, as will these PPI. PPI we already said. And looking like on Friday, consumer sentiment won't be as major, but we have CPI, we have PPI, we have FOMC minutes. Those are going to be very significant. So we do have the potential of some elevated volatility next week, and that is another reason why we just want to make sure we're well hedged. So make sure there's enough time value left in your hedge, make sure it gives enough protection. If not, then you're going to have to refresh that hedge, meaning close the existing one, open a new one, and start to move our portfolios into a more neutral basis. So that's where we are in the market. There's not that much else to say. It's not very meaningful for me to look at sectors or anything else because we're no longer trending in the same direction, or at least for now, we're not confident that we're still trending in the same direction. Right now is a point of readjusting the portfolio and getting it into a more neutral state. So there's really nothing else to look at here. There's an immediate and clear action that needs to be taken in the portfolio. So that's going to be it for this week. Hope you guys have a wonderful rest of your weekend. And I am traveling, and I'm traveling unexpectedly last minute. So I will not be able to do the morning pre-market analyses. So just watch out for these events that I pointed out. On those days, you're going to want to be very careful, and you just want to wait and see how these reports play out before you start to make major changes inside of your portfolio. And just be aware of the heightened possibility of volatility, especially on Wednesday, because that's where our core inflation, our CPI, and our FOMC minutes come out. And then again on Thursday with the PPI, well, the Wednesday will take a lot of the thunder out of the PPI report on Thursday, but it's still going to be important to watch. And then we'll round out the Friday with consumer sentiment, but after the CPI and PPI, that won't be as significant as well. So Wednesday, a lot of potential for movement and activity. That probably means that Tuesday is going to be a little bit more quiet as we're waiting for those reports to come out. And Monday, any volatility that exists will mostly be spillover from any events that happened over the weekend. So have a wonderful rest of your weekend. I will see. I'm not too sure of my schedule and how my travel is going to keep me occupied. So I will do my best to make the post-market analyses, but I'll have to keep you updated as we go, and for sure I will be unable to do the pre-market analyses until further notice, probably until Wednesday or Thursday. All right, guys, have a wonderful weekend, and I will see you later on.